Marcus mentioned the experience that when countries with state-directed financial system shift to a market-directed financial system, generally it generates at least one financial crisis along the way. China has not done that. Its financial system has been ring-fenced from the advance of the private sector. However, financial sector looks like it has become an unstoppable juggernaut in terms of increasing leverage. If you take a very simplistic indicator, which is banking assets to GDP, it goes up, and Bruegel can try to do deleveraging. It doesn't really show on the chart. It won't go up and up forever. Entrepreneurship or economic vitality has been really the engine of the extraordinary Chinese growth of the last 40 years. It's been unleashed by Deng Xiaoping. It wasn't really a plan. Deng Xiaoping was a practical policymaker when he came back to power. He first unleashed that entrepreneurial energy, that market energy in agricultural sector. And actually, his famous take that it's not a problem if some people get rich first was specifically about peasants. It was not about industrialists. At that point, he thought that the industry would remain owned by the state and there wouldn't be anything approaching capitalism in China. But he opened a door that has not been really closed since, or maybe recently, and that's what I will come back to. And what has powered the extraordinary Chinese growth path of the last 40 years has really been private sector enterprise. The state sector has declined in relative terms, very big state-owned enterprises, of course, through consolidation and public support, but it's the private sector that has created the jobs, the exports, and the productivity. Without much support, by the way, from the Chinese financial sector, because throughout that period, as Nicolas at the Peterson Institute and others have documented, the Chinese banks have overwhelmingly lent to SOEs, and the private sector growth has been fueled by retained earnings rather than external finance. So the big question now is whether something has been broken, and here I come to the chart, which is a tracker that Qianlei Huang at the Peterson Institute and I have developed in the last 2 years. And this requires some explanation. The red part of the chart, no irony intended, is the private sector, what we call non-public enterprises, and they're defined very conservatively as companies where the state owns less than 10%. So if you're in a company where the state owns 11%, be it through local government, central government, other SOEs, you will be in what we call mixed ownership, which is between 10% and 50% state ownership. And then the majority-owned state-owned companies are the dark blue, which is what we call state-owned. So what you see here is one thing that probably doesn't surprise you, but one thing that should surprise you. The thing that probably doesn't surprise you is you see the share of the private sector declining in terms of total market capitalization of the largest listed Chinese companies in the last 2 years. This, I should have said it earlier, is market capitalization. So it's a market indicator. It's an indicator of where the market sees future growth, future profits, future value. It's not an indicator of revenue, and the revenue curve would look a little bit different. But the important thing here is that throughout the period of Xi Jinping in power until 2021, mid-2021 to be precise, the share of the private sector has increased almost continuously. And if you were to look at revenue of the largest companies, listed or unlisted, you would see a parallel curve where the revenue of the private sector, it's lower in relative share than in market cap because the very largest companies in China continue to be SOEs, but you also would see continuous growth for a very low level when Xi Jinping took power. So what does this tell us? What it tells us is that until mid-21, the view of the market was that the private sector was on the rise despite Xi Jinping. I'm not saying because of Xi Jinping, despite Xi Jinping. But in the last 2 years, since mid-2021, the market had been changing their view, and they have been increasingly pessimistic about the future role of the private sector. I can go back to the methodology. I prefer to refer you to the piece we published with Tianlei Huang, just to say that this is a pretty robust observation. So the party cannot fake those figures. This is why we look at ownership and not what Marcus mentioned, which is Communist Party sales, because it's very difficult to interpret. But this is pretty straightforward and hard to manipulate. So, has the engine been broken? You remember that the famous speech of Jack Ma at the Bund Summit in Shanghai was almost 3 years ago. That, I think, will remain as the moment when things began to crack. And the question here is really whether entrepreneurs in China can hope to make it, to become Jack Ma, to get rich, even when they're staying into politics. Let's face it, Jack Ma was not intruding into Chinese politics that massively, but he was an iconic Chinese entrepreneur. And that's what the party has wanted to tame, if not to destroy, in the last few years. There are many ambiguities about the slogan of common prosperity. I don't want to make too much of the Chinese rhetoric, but I think when we look at the government actions, there has been a chill in the entrepreneurship community. When we started collecting those numbers 2 years ago, I thought it would be a blip and that the rise of the private sector would continue because it was so robust, including, as I insist on this, under Xi Jinping over almost a decade. But this has not been the case. I was too optimistic about the prospects for the private sector, so I think there is a genuine signal here that we have to take seriously. Now, let me finish with a few words about financial stability. Marcus mentioned the experience that when countries with state-directed financial system shift to a market-directed financial system, generally it generates at least one financial crisis along the way. China has not done that. Its financial system has been ring-fenced from the advance of the private sector. However, the financial sector looks like it has become an unstoppable juggernaut in terms of increasing leverage. If you take a very simplistic indicator, which is banking assets to GDP, it goes up, and Liu He can try to do deleveraging. It doesn't really show on the chart. It won't go up and up forever. At some point, there will be a correction in the macro financial picture of the Chinese economy, and that point is impossible to predict. It will come one day, so I'm increasingly concerned about that. Martin Charles-Empa at the Peterson Institute has been documenting the cashless revolution, the revolution of fintech in China when it comes to electronic payments that has happened in the last decade. But when you look again at the financial sector as a whole, what the Chinese authorities have done is really empower Alibaba and Tencent to put pressure on the traditional banking sector to modernize, but not to replace it. So the Chinese financial sector is this very fascinating beast. It remains very much state-controlled and party-controlled, which in principle should go in the direction of stability, but it is expanding without a limit in sight, and that should make us very concerned about the possibility of crisis down the line. This is frustrating, of course, because I'm not predicting a point when the crisis would come, but I will say a bit tamely that it's probably closer than it has ever been. Thank you very much.